Welcome to the Happy Cows Eat Smart podcast, brought to you by Novus AgriScience, where your dairy's business success is our passion. In our monthly podcast, we cover updates and insights within Federal Milk Order 33. Our team of expert ruminant nutritionists delivers research-backed, custom feed solutions tailored to your herd, because we know every farm is unique and no two solutions should ever be the same. We go beyond nutrition. Through robust tracking of herd metrics and financial benchmarking, we help you optimize costs, boost performance, and build profitability so you can focus on what matters: happy cows and a thriving business. So whether you're tuning in from your office or your truck, join us each month for insights, stories, and strategies that promote herd health, farm performance, and dairy success. Let's make your business thrive, one episode at a time. And now, Dr. Lawrence Jones will share his insights for Federal Milk Marketing Order 33.
Thank you, Ben. And I thought I would get started this month with kind of the theme that I'm thinking about and some of the things that I'm watching in the market here. And that is the dairy markets are just going to have to deal with the milk supply that we're providing. Now, what I suspect is going to happen in the next month or two is that we're going to end up with about 9.7 million cows. Now, this increase in cow numbers, as I showed you last month, has just been absolutely astronomical. It continued on. We ended up the month of April at 9,621,000. And my argument has been that this is a completely different run-up in cow numbers than we've had previously, because there's a lot more construction and the cows are kind of coming where there are new plant capacity. And the latest call data would also support this concept. This data is from the week of April the 26th. We only slaughtered 47,000 animals. Now, that is slightly more than a year ago, so the low was a year ago. But again, we've got almost 200,000 more cows. Right now, we're approaching a 26% call rate. My argument has been we've got to be above somewhere around 30, 32 for this herd to actually begin shrinking, and we're a long way from that at this point. So I truly expect this herd to continue to grow. I think as long as we're over 40 million pounds a day of cheese, it's going to be a burden. If we look at our cheese production for the month of March, now we'll get the April production here in another few weeks, but that was a record high for March. And then if we kind of look at where 40,000 pounds is, we've been above that more or less for the entire year. We dipped under it for just a second there, but we've been making 40 million pounds of cheese a day for close to a year now. And if I look at what I expect for the next year, except for maybe July and August, we're going to be over 40, pushing 41, maybe even pushing 42. Now, these numbers are a little lower than I originally suspected, because this number coming into March, it was actually down. And if you look back over time, there's very few times where we go into March with a down production. And that led me to make this other point, which is I didn't believe the latest USDA reports, because milk production month over month was up about 1%. But cheese production was down 2.4, and butter production was down about 6%. And they kind of steal a line from Ocean's 11, like, where did all that milk go? Because I really don't know. We think that there might have been a little bit more cottage cheese and yogurt, but I really suspect we're going to have some major revisions in these next dairy products reports. At the same time, we've been changing the complexity of cheese. We've been making a lot more Italian. This was on a downward trend, but it's been very much on an upward trend recently. American has been down off of its trend. Cheddar is actually right on its trend, and then other solids have been increasing a little bit over time here, but definitely a lot more Italian cheese than American and cheddar. You say, well, what about exports? I have a feeling that we're going to keep exports under 4.5 million pounds a day. If we look at the exports, they actually came down on a daily basis in March compared to February, and we're at 4.5 million pounds a day, but we need to stay above 4, and we've really not got a very good record of that. So it's only been about the last 2 months that we've been able to get above 4, and exports are really starting to get some headwinds. Freight costs are up significantly, and we've got a strong US dollar. Now what that means is when we used to be able to sell cheese at the border for $1.90, now it costs probably $1.88 or $1.85 just because of these headwinds. This is a history of the export cheese price, which is in red, and the National Dairy Sales Report in blue, and the numbers represent what percent of production we've actually exported. So we've been at 11% here for the last 2 months, and we've had a huge difference between the exported price and the National Dairy Sales Report. And I think to get really good exports, we need to have a 30-cent discount on the USDA number versus the export number. Now, we did have a global dairy trade back on the 5th. We'll have another one this next Tuesday. And I've actually somewhat decided that this is more of a long-term issue instead of a short-term issue, because when you look at cheese price, they're pricing from January out to November, where we're talking about cheese prices here in May. So these don't correlate with cheese price very well at all. There's a tremendous lag in this. Overall, on that global dairy trade, cheddar was down 3.6%, and we're pushing 209 on that. And the actual March exports, the number I look at is right here, the $1.83 for cheddar, because that's going to translate into our cheese price. And we ended up with a cheese price, in the $1.50. So again, that's at 30-cent discount. We did export around 11% of the actual cheese. Now, actual cheese that was exported was $1.96, much higher than cheddar. Again, the Italian's going to have some multiple of cheddar. Butter was $2.19, but again, that's 82% fat, where the butter that we have domestically is 80. But I would point out that the percent of cheddar that was exported was actually down from February, 6.81 versus 6.89. Anytime we have over 35.5 million pounds of cheese left over for domestic use, I think it's a bit of a problem. And the way I calculate this, let's look at February 1st. We had 41.5 million pounds of cheese a day. We exported 4.6 million pounds. We put a little bit in cold storage for the month, only about 5 million pounds. We ended up with 36.7 million pounds left over for domestic use. We had a $1.43 cheese price. Now in March, we produced a little bit less. Again, I have a question about that as to whether we did that or not. We exported a little bit less, about 87,000 pounds less a day. We put a little bit more in cold storage. We ended up with 35.6. We had a $1.56. So I think we've got to get the amount remaining down to 35.5 million pounds a day in order to get cheese prices coming up. And the only way you're going to do that is either by reducing production or increasing exports. But one of the problems with the domestic demand right now is the fact that the consumers are what I would say is a bit grumpy. The consumer sentiment is the lowest that we've had in quite some time. It's actually lower than this 2022 number. And then on top of that, we've got 3.8% inflation and $5 gas price. So consumers are not in the mood to go out and buy a lot of extra things at the moment. We're also having record-setting fat production. If we look at the fat percentages, this is the highest March that we've ever had on record. Now we're at a time of the year where we're having declining percentages, and we should decline accordingly. But again, according to history with March, this is the highest fat percentage we've ever had. And along with that would be the highest butter production that we've ever had. So butter production is very seasonal. We've been on this long-term trend and then actually accelerated a little bit here. So we've got just a tremendous amount of butter production. So where does this leave me? I think we're going to end up with $1.65 block cheese, about $1.60 butter, and 65-cent whey, which is going to put our dairy markets right around $17 for class 3 in the foreseeable future here. And if we look at the April settlement, came in at $16.82. Because a lot of people say, well, yeah, but the trade is telling us something different. Well, the trade was telling you back here in February that April was going to be $15.49, and then back here in March they were telling you it was going to be $17.85. So the trade's not been extremely informative here, probably for about the last 3 or 4 months. Now we know that class 4 prices are significantly higher than class 3. So this is clearly sending a signal to the market to make more milk. This is also going to increase our Class 1 prices because the Class 1 is the higher of 3 and 4. And the question is, why is Class 4 so high? Well, mainly it's due to non-fat dry milk, and we went over this last month, and it's exactly the same. We should have seen the fact that we had a shortage of non-fat dry milk coming 3 years ago. So we've been on this tremendous upward trend, and where we are now is a kind of reminiscent of 2017, 2018, but there's not been very many times that we've been higher than we are right now. So again, I don't think we're terribly out of line. And I call this a niche market to some extent because if we were to make 6 million pounds of non-fat dry milk a day, that requires 60 million pounds of milk. It's about a 10-to-1 ratio, and that's only 9% of our milk supply. So again, 9% of our milk supply is sending a strong signal to produce more milk. So what's going on with this whole thing? And it comes down to basically this. Cheese plants are getting high-fat milk. They've got 3 options that they can deal with that high-fat milk. One is they can separate the cream and sell the cream on the open market. That's not overly attractive at the moment. The other is they can buy non-fat dry milk and fortify their milk fats. The problem with that, they're going to be paying Class 4 price for that. Or they can go out and try to just get skim milk, even if it comes from a Class 4 plant, because they're actually taking the milk and using it for cheese. They now pay the Class 3 price. So basically, non-fat dry milk has been being pulled out of the dryers and pushed into actual skim, and that's going to the cheese plants and also other high-protein drinks. If we just look at the skim price, Class 3 was $10.65, Class 4 was $14.17, so that's $3.50. So a cheese plant can spend a lot of money to get skim milk to be putting into the fortifying plants instead of using non-fat dry milk at $3.50 a hundredweight. Let's turn to order 33 and what happened on your milk checks. Overall, it looks like it came up about $1.09 compared to March. Now that's adjusted for components. Now the fat and protein did come down. Again, that's the time of the year that we do have decreased components. So once the component adjusts that, we're 2107, which is exactly what is reported by USDA. And the statistical uniform price, which is 3.5 fat, is 1914. So just compare your statistical uniform price at 1914. The high was Florida at 2404, and the low was your neighbors to the northwest at 1743. Again, Wisconsin, Minnesota are very, very high percentage Class 3, and Class 3 is not very strong. But overall for the month, the statistical uniform prices were up $1.21. And so you were up about $1.40, which is a little bit higher than some of the other statistical uniform prices. This is partly going to be driven by what happened to the different class values. And there's $3.40 between Class 3 and Class 4. And you basically did not have any major depooling changes. Now, that's just kind of noise in there. But the highest increases were going to be down here in the southeast at almost $2 at $2.50. So we plot out your statistical uniform price. It's starting to look a little bit better than we've been having here for quite a while. And the only times that we're higher on these run-ups that we had in 2022 and end of 2024. Now our Class 1 price was at $18.66, which is not quite the high. We had $18.93 back here in August. Of course, we had $3.80 to that, so your Class 1 actual price was $22.46. So we'll run down through the different components of the check. Fat actually took away 80 cents from the check. It was down about 7 ticks and the price came down. Here's our fat price at $1.87. It came down 15 cents. Higher than we were in January, which was the low is $1.45. Of course, we've been as high as a $2.84 back here in July. But these look like they are going to just kind of trickle along here to $1.75, $1.80. And these are the closes as of Friday. Now, the order 33 was similar to where they were last year for fat. So again, no major change. There had been some significant uptrends, but that seems to have leveled out here. Overall for the country, fat was 431, decreased 5 ticks. You're 432 compared to the Northwest at 451. Those guys just know how to make a lot of fat up there. And of course, Florida now is below 4. If we look at protein, it added $1.33. Protein percentage came down 5 ticks, but the price came up 43 cents. So here's our protein price, $2.52. And these look like they are going to be trending up here. And I have a little bit of question if cheese is going to go up quite as high as it says it is here. But the high was back here in November at 301. Protein percentage for order 33 came up 4 ticks from a year ago. So again, protein is continuing up where fat kind of leveled out a little bit. And if we compare that to the rest of the country, the Northwest is highest at 353, and the Northeast is always the lowest at 331. So what's been going on with cheese price? So we are very much in a sideways channel, and I changed the look of this graph from last month. I decided we needed to look at this a little bit different. So we tend to run up and then boom, we run down. We tend to run up and then boom, we run down. And so right now we're at the bottom of this channel. And the question is this going to continue back up like it has historically, or are we going to run sideways here for just a little bit? And it has a significant impact on June milk prices. Other solids took away 18 cents. They came down about 3 cents. There's always a 3-to-1 ratio of change in other solids relative to class 3. So it's 39 cents. High was 44 back here in January, and these look like they're going up, but again, it's all attributed to whey, so we'll see if whey can actually support that kind of an increase in other solids. So those three together give us class 3. That came up 66 cents to 16.82, and the next 2 months right now are trading right at 17 plus or minus a little bit, which is where I kind of see the big picture is. January was a low at 14.59. A year ago was the high at 18.82. Now PPD is very much related to how class 3 compares to 1, 2, and 4. And just as an example, there's $3.40 difference between 3 and 4. So we've got a positive PPD, and that came up 74 cents. And we're going to continue to have positive PPDs probably through October with this class 4 as high as it is relative to class 3. Because this is going to drive up the price of 1, 2, and 4 with that high class 4. Finally, we'll just kind of finish up here with a little bit on grains. It's been an up week on soybean meal, and I put in the soybean meal channel here. We're very much out of this channel, so it's starting to look like soybean meal may have a few legs under it. You know, we've been looking at 285 to 315. Now, corn was down about $2.50 a ton. So what happened with the grain values is the WASDE report was very supportive of both beans and wheat for a production standpoint, and also for ending stocks of 26 and 27. Feeder cattle are still pretty strong at 353 on the Oklahoma market. They're still pushing almost $5 for feeder cattle, and live cattle came up 2 cents to 241. Finally, just to finish up with weather, we are going to get moisture across the south here, and we are going to build some heat in the west, and we've been bouncing back and forth of whether the heat is in the west or the east. But that rain down here in the south is very good to help clean up this drought monitor. Order 33 looks very good relative to the drought monitor. The hot spot right now is northern Florida, southern Georgia. That's just screaming red there. And again, most of the corn belt looks good, a little bit out here in the western part of it, but the ice states, by and large, are looking pretty good. All right, Ben, that's what I had for you this month, and so back to you.
Thank you, Larry. Novus AgriScience hopes you found this information insightful and look forward to next month's installment.